We're going to look at Halliburton, and this is an oil and gas service company. And what I do in my videos is I run a discounted cash flow model so I could figure out the intrinsic value of the stock and see if it's a buy or a sell. We're going to also look at the financial ratios at the end of the video. So the first thing we need for the model is the market cap, and that's 11.4 billion. And we'll put that in. And then we need a stock price, $12.98. And now we know the shares outstanding because that's the market cap, 11.4 billion divided by stock price, 12.98, equals shares outstanding, 878 million. Next, we need the free cash flow. And free cash flow is the way you value a company. What you do is you estimate the future free cash flow and you discount that number back to today's value. And that's what we're doing in the video here today. So I'm going to pull the last 4 years of free cash flow. And then I need the net income. And this is the profit and loss for the business. And that's on the income statement. And then we need the revenue, which is the sales for each year. Looks like 2016 wasn't a good year. They had negative free cash flow and negative net income. Looks like they had a big negative in 2018 as well, although they had positive free cash flow. So it must have been some non-cash items because the income statement uses accrual accounting. And the revenue looks fairly steady and it's pretty much growing each year. Let's get their capital structure so we know what to discount their future cash flows by. So they pay $592 million in interest on their debt. And let's see how much debt they have. We go to the balance sheet for that. We'll go to the liability section. And long-term debt is $10.3 billion. So that's debt due after 1 year. And they pay 5.7% interest on their debt. Since interest is tax deductible, let's get their effective tax rate. We'll go back to the income statement. Their income before tax is, we'll take 2018, that's 1.8 billion. And the income tax, 157 million. So even though they pay 5.74% interest on their debt, it's tax deducted and it comes down to 5.24%. That's the cost of debt. Now we need the cost of equity, so we need the company's beta, and that's the volatility of the stock. So the higher the beta, the more volatile and more risky the stock is. That's a high beta, 2.56. That means the stock moves about 2.5 times the market. So we also need a little more information from the balance sheet. Let's get their current assets. And these are assets which can be liquidated into cash within 12 months. And it includes cash, accounts receivables, and inventory. And that's 11.2 billion. We need the current liabilities. These are debts and payables due within 12 months. And that's 4.9 billion. We also need the equity. That's the value of the company according to the balance sheet. Total assets minus total liabilities, and that's 8 billion. Let's get their EBIT, earnings before interest and taxes, or operating income. And that's $2 billion. So now we know the weighted average cost of capital because it's a blend of cost of debt, 5.24%, and cost of equity, 22%. So 12.5% is their WACC, and that's what we're going to use to discount the future cash flows by. So we estimated 4 years of future cash flows, and then we did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $8.3 billion. We divide that by 878 million shares. And we get an intrinsic stock price of $9.42. So it's trading at 13. So that means it's trading at a 38% premium. It's a sell according to the model. Simply Wall Street is saying the stock is worth $13.34. So they're saying it's a buy. It's actually worth more than what it's trading at. Let's see the historical stock price. It looks like it was trading way higher in the 50s and 60s, but it's dropped quite a bit over the past year or so. Now let's look at their financial ratios, get some more information on the company. They have a negative PE since they have negative net income in 2019. It's not giving us much information on that ratio. A really low price of sales, that means investors are willing to pay 50 cents for $1 of sales. That's price of stock over sales per share. Pretty good price to book also, 1.4. Current ratio is good, 2.3, so they can easily cover their current liabilities. Negative ROE because they have negative income. interest coverage ratio of 3.5, so they can easily cover their interest payments. And they have 56% debt. Let me know what you think in the comments. Thanks for watching the video.